Okay. Hey everyone. Welcome to our ESG Trends webinar. And we're getting good sign in. So we're not gonna wait too long here. We're gonna get going. This session will be recorded, and we'll be able to share it with all the audience after today's session. So what are we here doing today? Well, we're here to talk a little bit about how we view the ESG market for 2024, obviously with a huge focus on real estate. And we're going to talk about key trends, both affecting real estate owners and operators, as well as capital markets, as well as the ESG market and ESG industry in general, and try and offer a coherent and insightful view into how that connects to real estate. So without further ado, I'll introduce myself. My name is Nuno, and I'm lead ESG advisor here in EMEA. I'm based in London. My background is particularly in sustainable finance. I spent just under a decade working in investment banking, and I then moved into the sustainability space. And so it's a big passion of mine. I also think real estate is it's a big sector, big industry to tackle a lot of our sustainability issues. And so it's with a certain type of advocacy that I take this role. So hopefully we can get into some good chats later on today. And just a little bit about Measurable for those of you that maybe aren't familiar with us. So we're the world's most widely adopted sustainability technology provider in the real estate industry. We serve nearly 1,000 customers across 93 countries, representing $2.5 trillion in asset value across more than 17 billion square feet of floor area. And the 93 countries is a big emphasis, hence why I'm sitting here in London. Measurable has a significant operation here in EMEA as well. And so without further ado, I'll pass it over to Scott to introduce himself.
Great, thanks, Nuno. Good morning, good afternoon, good evening for our audience. Scott Lemoine, lead ESG advisor, mainly overseeing the North America market, although Nuno and I do operate globally. I've been in the real estate, ESG, sustainability space for over a decade now, primarily in consulting and developing ESG programs, consulting on strategy, building performance, certifications across the entire gamut. So I think our conversation will be really insightful based on our experience with our clients, our past experience, and then a lot of what we've been seeing at conferences, what we've been seeing in terms of subject matter expert discussions. So really excited to dive in. Just a few quick housekeeping items. We'll have a recording of this distributed within the next 24 hours or so. So if you do drop off early, no judgments. The chat is also open, so feel free to drop any questions. We're going to try and get to those at the end. So try to reserve 10-15 minutes at the end. So we may not answer them when they come up. And I will send a recap out shortly after as well with the recording. So no need to take notes. We'll have a summary there as well. So today, as Nuno mentioned, we're going to be talking about ESG trends and what we're seeing in 2024. A bit about what closed in 2023 with COP28. But also what we're seeing in terms of regulation, both in the US, North America side and in the EMEA side. We'll also be discussing supply chain transparency and a big emphasis on overall disclosures in areas that aren't directly related to the business, but are tertiary elements to business. And then hopefully we'll have some time to talk a bit about biodiversity and the economic macro factors that I think we're seeing impact the real estate market. So. And I see a question come in. I'm based out of Denver, Colorado, and it is currently dumping snow right now. So that's a nice little surprise. Anyway, so Nuno, let's jump into COP28. And I think it was a pivotal event, as it usually is, in the climate change battle, right? But this one has particular emphasis in the real estate sector. Can you talk a little bit about the building aspect there and what was passed or what was launched? and how that will potentially impact the market in 2024?
Yeah, absolutely. So obviously COP has become, that annual event that everybody kind of looks to who works in the climate space, and generates a lot of headlines. And but I think the interesting thing to take from COP usually is what are the initiatives that come out of it, and who's been there, who's attending as well, which is a key proponent in making it a success. So this year, there were a lot of real estate companies that attended, and there was a initiative defined as the Building Breakthrough Initiative that was declared at COP, and it underscored a pretty compelling vision. So it effectively focused on us getting to a point where we can achieve the infamous idea of a near zero emission building. And not only that, but also focusing on how we can adapt buildings to the ever-changing climate that we have coming. And so there was a lot of positivity that came out of it. There weren't any particular targets yet set. This is something that's going to come. In fact, actually, there'll be a meeting / conference being held in France in March, I believe, after the MIPIM real estate conference, that is convening a lot of the countries that signed up to the Building Breakthrough Initiative, and trying to basically integrate some targets. There was a lot of rumors that there might be some targets around 2030, which is only really, it's less than 6 years away, so it's not that far to go. But I think one of the key positives coming out of it was that this isn't a lofty goal, but more of a mandate for the future. And so there may be, people in the audience who are familiar with net zero and CRREM pathways. And, CRREM is a tool that we use a lot at Measurable when in helping our customers define those decarbonization pathways. And of course, it leads us to talk about decarbonization with this, which is a big theme and a big topic when we talk about ESG in real estate. And so interesting, in fact, that we're starting to get to that point where it's not only those early adopters of ESG in the real estate space that started reporting on sustainability a decade ago. It's starting now actually to beg the question: is this something that gives real estate owners and operators and investor a return on their investment? And brings up this theme, which is we keep hearing about, and we're actively engaged in the discussion, which is the brown discount versus the green premium. And where are we on that sort of adoption curve with regards to decarbonization playing out? And I think this is a good segue for me to turn it back to you, Scott, and ask, have you seen any of these brown discounts or green premiums coming up in real estate transactions in your conversations with clients?
Yeah, I think the brown discounts have been a bit of the boogeyman, right? I think everyone's aware of, lower valuations on inefficient assets or stranding assets when it comes to CRREM. I don't think the market has seen significant impact from that. I think if anything, we see like opportunity funds, right, around certain assets like that. The green premium, I think, is still being defined as well. There's been a lot of research out on green buildings and commanding higher rents, right? But I still think that it's not a key differentiator in the market, but we will see it become one as they become risky assets to own, right? Or advantageous assets on the green building side. So I think that it's setting the foundation for what we're going to expect to see in the U.S. market. But I know that, there's differences, and you guys are a bit mature than us when it comes to the regulatory side and the framework side. But, we're not too far after. So, but I do think that you did speak to a good point on essentially the combination or the transition between voluntary disclosures and mandatory disclosures. We'll talk a bit about that later, but lofty net zero targets versus actual real practical targets, right, is becoming a conversation now. So we'll go ahead and turn that question to the audience though too. What do you think? Are you seeing brown discounts Are you seeing green premiums in your markets? I know it's very much a hot topic, right? But ROI is the basis of the real estate industry, and we want to make sure that everything's aligned, right? So,
Yeah. No, no, it's interesting. I believe there was a survey done by JLL in the UK last year where they sort of polled members of the real estate community whether they had seen any signals around, any premiums with, I think they were focused on BREEAM certifications on buildings, and whether a BREEAM Excellent had any sort of premium evaluation versus those with lesser certifications. And they came out with a pretty positive result. They said around 70% of people believe that they had already seen a green premium, or came across a green premium in their day-to-day business. So okay, we've had a few responses there. Looks pretty even.
Looks pretty even. And it's funny because a lot of the initial studies were on office assets, right? And it makes it a bit more challenging post-COVID to do follow-up on those. Because rents are a little bit out of whack compared to the baseline. But I think that the results are still pending. I think we'll see them, but there's no question that's the way the market's moving, especially when it comes from the risk management perspective that we'll talk about here in a minute. So yeah, almost an even division, 50-50.
Yeah.
So yeah, on to our next topic, and that is regulation and mandatory regulation, especially in the U.S. market. It's been the hottest topic, right? We have the SEC proposed ruling coming hopefully soon, although I wouldn't hold your breath. I think we'll see some finality with that. And then the California legislation that was passed. So these are mandatory disclosures around emissions and climate risk, each having their own differences. On the SEC proposed climate ruling, there's essentially two main components, although it does get a bit more granular. The first is Scope 1 and Scope 2 emissions reporting, right? So really looking at essentially direct emissions, both from purchased power and that's used on site. And then Scope 3 has been in a bit of a limbo. I'm hearing mixed reports. Some say it's pending, some say it's been scrapped. But the whole caveat around that is that Scope 1 and Scope 2 are going to be required, with a level of verification around that as well, depending on company size and maturity. So there's an emphasis on the data that's needed in order to report on those. A lot of companies have been doing that for a few years, some longer than others, some are just getting their hands on it. But essentially that's going to be a requirement, right? And that's a financial risk of non-compliance if you're not meeting those SEC proposed regulations and disclosure rulings. The second component is the climate risk aspect, right? So essentially requiring granular reporting in alignment with TCFD, or the Task Force on Climate-Related Disclosure, late TCFD, which was disbanded. Essentially, looking at how are you managing climate-related risks? What are the financial impacts on your organization? How do you expect in the short term, medium term, and near term for physical risks such as heat stress, flooding, et cetera, to have an impact on asset value, for example, operational expenses, potential litigation coming out of human health and public health impacts, and a lot of those areas are very mature, right, to a certain degree when it comes to the ESG spectrum. We don't see everyone reporting on TCFD. I think it has been now is becoming a business as usual reporting indicator. So that's going to be a significant challenge, right, in getting the data points that are required to be able to report that level of granularity. And then the California regulation, which they were able to beat the SEC when it comes to the deadline, is very similar. So we have California SB 253 and 261, two very related to the SEC regulation around the disclosures. 253 requires reporting around Scope 1 and Scope 2 emissions in the near term. I think 2026 is the requirement for those disclosures, and then Scope 3 will follow in 2027. So again, Scope 3 is coming back up. We'll talk about that a little bit more here in a minute. But also climate-related risks and reporting on the financial impacts at a certain level of granularity that most organizations aren't used to or aren't equipped to do so. So again, very, very similar, but the common themes: mandatory regulation and requiring data that a lot of companies don't have or aren't confident in. So I think we'll see this year being a very heavy focus on data governance and really making sure that the financial statements are just as accurate as the climate related statements, but vice versa. So yeah, I think it's going to be a really hot topic. Focuses on the data, quality in is quality out. But I'm curious, Nuno, what about your perspective in the EMEA side? I know there's been a lot of advancements on the CSRD side, as well as some on the SFDR regulation side.
Yeah, thanks, Scott. I'm glad to see the US, catching up to where we are in Europe. Just a little dig there.
We're trying.
To my my North American colleagues. No, it's great that this is. I think it sounds like we're almost there in terms of the SEC regulation. Hopefully, it's something we can start seeing being publicized and published this year. So that's great. But no, on the European side, we've been doing it. We've been on the regulatory side a little bit longer. When the SFDR was launched back in 2021. And so you could say that real estate investment funds are a little bit more familiar with needing to disclose on sustainability data, and so they've been doing this a little bit longer in the US. Not to say that the data quality is better or worse for any of that matter, but there's still a huge emphasis on data collection. Especially if you have a lot of residential portfolios, it's difficult to get that tenant data, and so it's an environment that is now going to become more and more sort of broadened. So it's going to go not just from financial focused businesses, but it's actually going to spread across industry. And there will be some businesses that will have to report with SFDR and will now also have to report on CSRD. CSRD is the Corporate Sustainability Reporting Directive, and it's going to impact around 50,000 companies in the wider European geographical area, and it's effectively around bringing sustainability reporting more in line with financial accounting. I think a good way to think about it is, financial or GAAP principles, in the US, for example, was something that started after the Great Depression and, after in the early 30s. And look how long accounting took to get to a point where, its governance was what as we know today. So we're going at breakneck speed with regards to sustainability reporting and sustainability regulation. So there are things that are not going to be perfect first time out, and this is what we saw with SFDR. SFDR was a regulation that was really aimed at sort of investment, your typical investment fund that invested in equities and bonds. It wasn't particularly tailored to a real estate business. Therefore, a lot of the technical screening criteria that will allow a real estate fund to show how sustainable its investment activity is not quite there. And so there was a public consultation that was done at the end of last year in an attempt to gather feedback from the industry to try and improve on these on the criteria and on the way that the regulation is categorizing funds. And interestingly, at the end of last year, we had the UK came out with the SDR, which is the Sustainable Disclosure Reporting, and this was interesting for two reasons. One, because the UK has incorporated a labeling system in its sustainability reporting, which is something that the SFDR hadn't done. This SFDR focused on a classification, which wasn't meant to be a label, but the conclusion had been that a lot of financial service companies used it as labels. So the UK in effect have kind of stolen a march a little bit here on the EU. But I believe that the public consultation that the EU conducted on the SFTR at the end of last year will incorporate now similar labels to what the SDR in the UK have done. Just to give a quick example of what that looks like, and I don't think it will be too different for what we can expect for the SFDR. The labels for the UK are, they have 4 labels. Sustainability focus will probably be the more likely to be the more dominant label. And then we have sustainability mix goals, sustainability improvers, and sustainability impact. And this will be interesting because there was a big debate in Europe around, right, what is a sustainable building? Or what is a sustainable investment in the building? Is it taking a poor, a poorly operational building from an energy perspective, making it more efficient, therefore reducing its energy consumption, and making it greener that way? Do we not need to be doing those things as well? And shouldn't that be classified as something sustainable in the realm of sustainable investments? This is something the UK have done well. They've incorporated it into the sustainable disclosure reporting. And so hopefully we can see this come out with the SFDR. The CSRD is something that the big thing out of CSRD, apart from it expanding across financial services, is that it's going to spur the reporting of double materiality. And what is double materiality? It is both the impact and financial materiality. So it's information that is material to the building from both perspectives. So so it's taking the view to like, well, what are the things that are material that could impact the building? You could say something like a flood, the risk of flooding, that's something that could impact the building. You've got to find a way to report on that. And then what is financially material? So what are the things that are actually going to affect the financial viability of this building? So CSRD will really ask that question. And it will tie in very much also with the ISSB, which are the new IFRS sustainability reporting tools that have that were published last year, both the IFRS S1 and the IFRS S2. And this is, Scott, this is what you mentioned, where the TCFD has now been disbanded but incorporated into the ISSB. So, but as you mentioned in your opening on the US focus, Scope 3 emissions and supply chain emissions are going to be a big focus of this. So maybe it might be useful for us to kind of go into that in a little bit more detail.
Yeah, but before we jump in, one thing on your last point, I think we're seeing consolidation, right? I mean, we probably should have attached a glossary of acronyms, and that's it's half the battle, right? Is wrapping your head around how fast things are changing, consolidations, et cetera. But it's rapidly evolving and getting a bit more efficient, I'd say. And my perspective on that really is, not looking at it as an obligation or needing extra resources to comply with reporting, but really positioning yourself in front of the investor community, right? The disclosures that are required out of all these frameworks are to enable investments into the industry, right? To screen investments, which can positively impact you or negatively impact you depending on how you're reporting and what the figures are. But it's not reporting for reporting's sake, so to speak, right? This is just like financial reporting, and that those figures are used ultimately in investment decisions. So jumping into scope 3, though, we mentioned a little bit about supply chain transparency and the reporting requirements around there. What are you seeing, Nuno, in the European market and the EMEA side around supply chain due diligence, tracking of supply chain emissions, supplier screening? I mean, there's entire programs being set up in organizations to manage this much more than just the accounts payable, right?
Yeah, absolutely. And so we've got here in the EU, we've got some Scope 3 emissions templates that have been published. The main one in the EU is the CSDDD, so that's triple D. So a lot of D's in these acronyms, but I mean, the thing to remember around the Scope 3 emissions is that we're looking at the indirect emissions of a building effectively. Scope 1 and scope 2, like you described earlier, are really, those are the things that are under the control of the owner of a building. The scope 3 are usually the things that are out of control of the building operator. And we have a whole host of stakeholders that will be involved in this process. Everything from property managers to developers, construction companies, depending which way you're looking at it. So it can be a bit of a minefield. So let's try and lay it out in a more sort of simple perspective. So we have two methodologies, at least here in EMEA, which are sort of the leading reference methodologies to use when we're calculating scope 1, 2, or 3 emissions. And that is the GHG protocol, which is the greenhouse gas emissions protocol. And more recently, we've had the development of PCAF, which is the Partnership for Carbon Accounting Financials. And they both have slightly different approaches. But if you're using the GHG protocol approach, it's very much taking a operational control perspective. So what is under your operational control as a business, and what isn't? And if whatever is outside that scope, you can categorize that as scope 3 emissions. With regards to PCAF's gone into a little bit more detail, understanding the nuance in not just investment funds, but real estate investment funds as well, where if you invest in commercial real estate, there is often you will have not just equity investments, you may also have debt funds that are also under your responsibility. And a lender to a building has a very different way of calculating the emissions from that perspective. You've got to look more into financed emissions for that perspective. And we can go down lots of rabbit holes here, talking about the different calculation methodologies needed for finance emissions versus equity, versus if you're a lender. So I think for the purpose of this, we're going to try and just step back a bit and do a little bit more high level.
Yeah.
So I think if we look at it from if you're a real estate owner and operator, scope 3 emissions will typically account for over 85% of a commercial real estate company's entire footprint. So, and this could be one of 3 things. It could be, a building developer reporting emissions from construction materials used in a new building. So this is very much the embodied carbon piece when we're looking at whole carbon building emissions. Another example could be the building owner reporting emissions from the energy use of a tenant. Again, this brings up all sorts of challenges. You really need to have a good tenant engagement policy, embrace stakeholder engagement as part of your due diligence, and as well as ownership phase of the ownership of that building in your portfolio. And then the third piece being an employer reporting emissions from, let's say, your employees commuting to work. This is a more of a corporate approach to looking at scope 3 emissions in that perspective.
Yeah.
So there's a lot of different factors to consider. There's a lot to unpack. It's definitely going to be, I think, something we're going to see more articles being written about, more events focusing on this as we dig into that detail about how to go about calculating scope 3 emissions.
Yeah. And to add to that, it's a complex category, right? I mean, 13 categories of scope 3 emissions. Not all are material to every organization. There's still some kind of gray area around, what is material and what should you report on. Just because you can't track it doesn't mean it's not material. It just means it's another challenge, right, so to speak. And then, when it comes to the supply chain side, a lot more conversations between suppliers, vendors, and ultimately real estate owners, right? Because those emissions from your supply chain are impacting your overall performance when it comes to reporting all the way up. So you may see a little bit of a tighter market around, how efficient are you? Do you have your own policies and programs that you can report to us on, that we're seeing, more advanced reporting on that side? But again, it goes back to the data and what you have, what you don't have, and then identifying those gaps.
Yeah.
Yeah.
And I think also the if you look deeper into the regulation, both I think in Europe and in the US, you'll see that there's a lot of talk of needing to conduct materiality assessments around scope 3 to really understand what is sitting in that groupment, so that you can properly then discard things that are not relevant and include those emissions that are. So it's going to be an exercise here for a lot of real estate companies to do as well.
Absolutely. So a next trend that we want to dive into is a bit more of the general economic climate. We've seen
Scott, just one. Sorry to interrupt you.
Yeah,
We
no
do
worries.
have a little emissions poll to see. So of our audience, who here has already been measuring scope 3 emissions?
I think this will be a little different than the last one. Be surprised.
Yeah.
We got back to 50-50, but it's also how many of the categories are you measuring, right? So there's another level or layer to that question.
Yeah.
Okay, so actually closer than I thought. I'm actually really surprised.
That's great.
Okay, so jumping into the next trend that we're seeing, and I was mentioning that generally we were aware of the economic climate, right, when it comes to the ESG professional side, but in real estate, it's top of mind, right? Interest rates have a direct impact on cost of capital. We saw transaction volume drop tremendously. It's picking up a little bit. Mixed opinions on where we're going to go, right, with the rates, but in general, things are tightening up, and ESG and sustainability have not always been prioritized when it comes to preserving OpEx, right, and making sure that the company is still making money as a real estate organization and not spending on things that aren't essential at the time. What's your perspective on that, Nuno, and how are you seeing I'd say the impacts in Europe, right? Not direct, but still related, impacting the overall spend on ESG and the momentum in the ESG and sustainability industry.
Yeah. No, it's been, I mean, for sure, 2023 was a real, I think, shock factor is the word that comes to mind. I think, we've entered this, we had that shock with the interest rates coming up. A lot of people pressed pause on, any investments they had. They focused on, understanding the environment. How long are we going to be in this sort of, new higher interest rate environment? And really, I think, just sitting back and trying to, focus on the operations of the buildings and do that to the best of their ability. And so there was definitely, I think, a reduction in overall demand, I think, for ESG products and services last year. Interestingly, here in London, we've attended a few real estate conferences, industry conferences at the beginning of this year, and the level of optimism is starting to creep back in, which is great. I mean, not just around ESG, but around activity, real estate transactions in the market. And there are some particular areas that are being favored at the moment. There was a lot of talk on residential being the sort of the new hot area to invest in from a real estate perspective. The demographic trends really support that. We have the more people in retirement age, senior care living homes are in short supply, so there's a big opportunity there to invest and build that out. Logistics is also becoming is still staying very strong and will consider to do so, because we've got this whole big mega trends of reshoring from Chinese manufacturing back into Europe, and Europe, land is scarce, so that's just going to help push prices up for logistics owners. So I think there's a lot of talk was around, there's a lot of dry powder, as in a lot of money sitting on the sidelines waiting for the right time to come back into the market. And a lot of people are saying that the second half of 2024 we could start to see a big uplift in that. And with that, I think, ESG is no longer in isolation. It's no longer a tick boxing exercise. It's really part of the investor due diligence. It's integrated, and it's coming at it from all angles, whether you're a lender, you're an owner, or you're a tenant occupier. So I think we can expect some interesting things in 2024.
Yeah, and I agree. I think, despite the economic climate, the ship has sailed on a lot of these requirements, right? The disclosure requirements, when it comes to mandatory requirements and voluntary, nothing really changed. And I look at it from the reporting perspective because that's a big driver behind what companies are doing, right? You look at GRESB and how successful GRESB has become and how it's driven organizations to compete with each other. So the ship has sailed. There's a lot of momentum going. The expectations have been set. So, I didn't have any clients that stopped reporting last year because they had to tighten down, right? They were already doing it. They already had it in their budget. But I did recommend, like you said, to really focus on the OpEx side, right? Energy efficiency is huge when it comes to, trying to ultimately make the most profit you can while having a higher value asset across the entire portfolio. Not everyone was as active, right? It was a bit of a fire drill for the most part, but yeah, like I said, things are going to continue to move forward regardless of the cycle.
Yeah, no, I agree. And they're definitely, I think one of the other things I picked up on at the beginning of this year at industry events has been that the office is not dead. And it's interesting because we, obviously, I mean, Measurable, we're a remote company. And it's, there are many companies that have gone remote, but there are also a lot of companies that have embraced hybrid working. But the office still plays when we get together in person, it still plays a, very important part in our sort of collaboration, communication with each other. That physical community is important. And there are a lot of people talking about that, the office will always have a place in a real estate portfolio.
Yeah, I think we've been through the stages of remote work. A lot of us have, right? The excitement, then I don't have the setup right, to I miss my coworkers, and then needing the collaboration. So I certainly agree from that subjective perspective. It'd have a big impact on London if it didn't pick up. So So I'd love to jump into some questions, Nuno, just for the sake of time. I know we have some to work through. First of all, I thought Elizabeth had a really good question. There's a million things to report, but using Pareto's principle, what are the 20% that have the biggest impact, and how can you get the biggest return on that effort?
Yeah, that's a good question. Well, my first part of that answer would be that we have the compliance side, so that's the stuff that you have to do. Therefore, it's probably wise to focus on that first. But rather than just kind of be driven by the stick, what you and I like to talk about is how can you embrace sort of smart compliance, take it beyond compliance, and really have it something baked into and integrated into your business decisions. And I think that's where, that's an exercise and a conversation you and I like to have with our customers is, okay, we've got the compliance, this is what we need to do, but how can we take this a step further and really integrate this into the business and start seeing a return on that investment from not just a data insight perspective, but how that can, drive favorable business returns.
Yeah, and I think it's not a one size fits all approach, right? So just as business strategy is unique to each organization, so is sustainability, ESG strategy. We had a question about the recent developments in terms of the social part of the ESG in the real estate sector, KPIs, metrics. I'll weigh in on that, in that I think the jury's still out for the most part. I think that there's such a diversity in the social metrics those that apply based on like organization, asset class, et cetera, right? You have, affordable housing being an element in multifamily residential. Local community enhancement is not as big in the industrial side, although the opposite can be true. But I do think that GRI has set a really good foundation. Global Reporting Initiative, Global Reporting Standards has set a good foundation for social related metrics that apply to most companies, right? When it comes to workforce, employee engagement, those kind of things. I don't know if you have any other thoughts on that from your side.
Yeah, no, I agree. I agree with what you were saying, and I think if we take a look at the offices that sit in a lot of our customers' real estate portfolios, this with the effect of COVID and remote working and all that's happened since, there's definitely it's risen awareness in terms of like the health and well-being of tenants inside buildings and offices for offices to be attractive to for their employees to come in and spend time there. There's going to have to be a focus on that social side. And so I think, yeah, I just see that going from strength to strength in terms of forming part of that, overall ESG reporting.
Yeah, I think it's a bit of analysis paralysis, right? There's so many things to measure. There's HS&E, health and safety, occupational safety metrics, right, that are pretty standardized. But then you're looking at how property owners responded to COVID, right, with certain air filtration improvements, UV lights, those kind of things. So it's a wide gamut, but I do think that it's starting to crystallize a little bit.
All right, so Genevieve's question, are you seeing that any company is reporting on all 15 categories of scope 3 emissions with offsets separately? And is anyone reporting on what percentage of their total portfolio is actually truly net zero under the Paris Agreement, not just net zero operational emissions? Yeah, it's a really good question. I would say it's definitely a minority.
Yeah.
Yeah.
I'd agree. I think there's very few organizations across every industry that are reporting at that level. When you go to the real estate industry, there's only a few. I can name off the top of my head. But I think that even those that are reporting at that level of granularity and that extent are questioning how much they believe in their data when it comes to getting that verified for reporting. They're doing business in California as part of the California regulation, or the SEC pending the outcome on scope 3 requirements there. So even though they have it, I'm not sure the confidence level is as high as it could be. And that'll be a kind of a moving stick as we get a better grasp on that data and have it be investor grade data as financial reporting is today.
Yeah. Yeah, agreed. So do we have?
So we have a few others in the webinar chat. So we had a question from Robert on the culture war against SEC ESG mandate playing out in the US. There's a lot of opinions on this, right? I think there's a lot to consider when it comes to this. It's a loaded topic. What I will say, in my perspective and in my experience, a lot of the organizations that are leaders in this space are investing in this space and part of their own ESG sustainability program are not fazed by any of the political talks around this. I think the culture war is notable, right? It's a topic, but at the same time, we're not seeing that impact progress. We're not seeing that impact investment, at least, on the larger scale. Some states, of course, are having some changes in their investment laws and whatnot. Pension funds are reconsidering certain investments, but I think it's more of a drop in the bucket.
Yeah, and I would say, I mean, from our perspective here in Europe, it's not politicized in any way, and if anything, it's no longer an isolated term. It's something that's being integrated into most financial investments.
Leslie had a question. How are companies balancing between supply chain tracking, compliance, and financial profitability?
Yeah, that's a great question. How are they balancing? Well, I think this is where, a lot of the conversations that we have with our customers is really around that data quality, because you need that to inform um, the right KPIs and metrics that you set as a business. And if that's not based on accurate data, it's it's a fool's errand in a way. So it's something that it's one of the reasons why I used to work prior to Measurable. I worked for a consultancy that did a lot of consultancy in real estate, and but they lacked a a team with some good software or data advisory, and it was something I saw a real gap in, and so it's one of the reasons it brought me to Measurable, because I wanted to really get involved in this space much deeper, and I think it's become ever more apparent to me how important it is, and one informs the other, I think.
Yeah, yeah. And I think, to close on that, data it's known as a very challenging aspect of the entire equation, but I think the acronyms, right, the new reporting frameworks are drawing everyone's attention, right? Specific investor requests on aligning with the framework, and that's where the attention goes, right? What's new, what's coming, but it all ties back to the underlying data element, right? And not just having it, but having systems in place for automating that, and making sure that that's being tracked year over year, right?
Yeah.
That's a fundamental underlying component of being able to report to these regulations or to these frameworks that the investor community is asking for.
Yeah. Agreed. And there will be consolidation in a lot of this reporting, in years to come as well. We're not quite there yet, but there will be. Okay, I think we're at about time, aren't we, Scott?
Yes, we are. Yep. Thanks to everyone for joining. We'll distribute a recording of the webinar and recap in the next 24 hours. So really, really appreciate the great questions and hope everyone has a great rest of the day.
Bye, everyone.